everybody was like this, holding the money.
Because they don't want to be the ones to make the wrong decision as well. If they make the wrong decision, because if you made the decision to start lending credit, because a lot of the dry powder is really in the capital stack, not as common equity, right? That's not where they play. They're playing in first position, they're playing in prep, they're playing in mezz. That's where they want to play, right? And in that space, if you had deployed thinking that coronavirus was the catalyst, guess what? Those people are being rocked right now. So the same people who have the quote unquote dry powder also just got hurt on their bets that they did when they saw coronavirus hit, because it was all short-term capital.
I want to say what I'm thinking, what I'm trying to ask you, Eric, is if Blackstone is buying something for $1 billion or $10 billion, you said? $10 billion. Are they buying into distress, or are they buying into positive cash flowing assets? That's what I want to know.
I think their gut feeling is probably like, now it's time to buy because things are going to get better.
That right there is very valuable for the people at home to hear, right?
If you think things are going to get worse, it doesn't matter if it's distressed or not, you're not buying. It's like rich people can buy a nice house anytime they want. They can buy a watch, they can buy a car. If they feel that the housing market's going to keep going down, they'll rent. They're not going to buy a $20 million house that they think is going to be worth 15. Rich people are usually pretty smart, and they get it. They get the timing. So it's the same thing. It's really the same thing in all markets, right?
I also perceive they probably got a discount with the reset valuation, understanding where the capital markets were when the $10 billion. That $10 billion on that acquisition maybe was $15 billion at the top of the market, or $16 billion. They probably still made the right trade.
So wait, I want to go back to when I said Gabriel's a fifth, watches off a fifth. Okay, talk about
Gabriel the fifth.
Yeah, take about
two shots. Look at that.
Yeah, talk about the bottom of the market. So is Blackstone saying they're at the bottom of the market?
Unfortunately, I wasn't in the investment committee meeting with them. But all I'm saying is it's indicative of the biggest global real estate investor is now making a big bet in the U.S.
We should call a spade, okay?
Okay,
the smartest guy in the room is making that bet. What Eric is saying is that others will follow now.
No question.
Because they're not the first one to make that bet. If the smartest people in the room, or a perception of it, who have 1,600 data scientists and they have all the data out there and they're seeing all the trends, and then they're saying like, let's lay up $10 billion, guess what? The rest will follow. That is what he's saying. And that may be the spark for transactions. Does it now trickle down to the mid-market space, to the mom and pop, to the mini institutions, to the billion-dollar credit funds? Who knows? Yeah. But now you're not making a mistake, right? These guys have boards that they have to answer to in investment committees. Now they're not the first ones to getting their heads chopped off.
It's like I call it the Disney moment, right? 20 years ago or more. Disney opened a store in Times Square when Times Square was negative. It was, Times Square. Within like a minute, everyone's like, Disney store in Times Square? I want to be in Times Square.
So the real question, Leo, is what were the signals? That's what you're really asking. What were the signals that Blackstone is reading on the parchment paper in order to make their decisions, because others didn't see the same signals? What were the precursors that they're seeing in order to make that decision?
I think the precursors that they see is, like I said, I still characterize this as a distressed transaction because they bought it at the bottom of the market when it was higher. Allow me to explain. There's a property in Midtown. I can't, give you the address.
Remain nameless.
You can tell us. We won't tell anyone.
It is 100,000 square feet or 85,000 square feet. It was trading for $85 million. October 23, 2023, trading for $85 million. I want to ask you something. How much do you think it is trading for now?
Or will trade for?
23.6.
$33 million. Yeah, you're not too far. You were close.
Nice work.
Good.
Did it lose a tenant?
No, it did not lose a tenant. It lost momentum. And I think I want to talk about that as well. Momentum in real estate is extremely, extremely important.
Can I challenge you?
Of course.
When you say it was trading for, maybe somebody made an offer, but
yes,
it didn't trade.
It did
In
not.
other words, the buyer didn't close, the lender didn't show up, the
Right.
seller didn't get the money.
Correct.
Okay, so it may have never been worth 85.
May have never been.
I mean, this
worth
is what we
85.
deal with all day long, and it like
Value.
all
We're
day
going to talk
long.
about value. We're going to talk about
What
value.
I was going to say is, an owner would say, "I got an offer of $50 million." Okay, that was 4 years ago. That's completely irrelevant. What does that have to do with the price of tea in China? Nothing.
But let me give you the little twist. It was because the reason it was not accepted, it was because the amount of the deficiency, and I'll explain to you what a deficiency is, and with the guarantor was $15 million, and the guarantor wanted to cover their deficiency. Now, what does deficiency mean? Property's worth 85. The debt that is owed is 100 million. 15 million of that is recourse to or passes to the guarantor who guaranteed that debt, and that is why that guarantor did not accept or consent to that sale. All right.
Did he even know about his taxes on the discounted loan position, that it's income?
That it's also income. When you get that forgiveness, it's actually also income.
Yep.
This is a good reminder for everybody in the real estate game. Please go to your tax attorneys. Please go to your CPAs. Don't think that if you short sale a property and you save $100 million, that you're scot-free. The IRS will send you a bill for $100 million. That'll be at a tax bracket of 40%. Right. You will have the same exact problem. And if you need to get lawyers, go to Jacobs PC. But besides
Leo, can we back up for a second? Because I think you said something interesting, which is where are we on this timeline of sort of distress in transactions, right? And it has changed because things are moving. So you said earlier in the court system, it's starting to pick up. Outside of the courts, it started to transact. Well, guess what? As Eric was saying, is that the lenders are getting more aggressive. They know that they're stuck. So they're coming after their borrowers, and some of them are out of court settlements where they're giving the keys back. So what we're seeing is the lenders are starting to come to us. They need those players in the game that know enough about capital markets, construction, and development to complete those assets to then go out and get more of their money back. That wasn't happening 30 days ago or 90 days ago or 120 days ago.
Valuable.
We just picked up 2 deals where the lender took it back. That means they foreclosed, and then they needed a principal developer to then finish that asset. That is further down the timeline. Next, do they take it back and then flip it? And then you're going to hear Eric say, we're starting to sell assets where our client is the lender. It just so happens there's no more debt on it because now the client became, the lender became that actual client. So the real question is, hey, Eric, are there more clients coming that were really credit funds that took over the assets that you're now trading it? I'm thinking that is what's happening. We are seeing today that the lenders have foreclosed and they're now underwriting and trying to determine what is the best position to move forward. That means it is moving down the line, and I perceive there will be more transactions as a result.
I'll tell you something else, and I'll pitch it to Dorian. I have a very important question for you. If the representation of transactions beginning, or the confidence in the market coming back because of the $10 billion transaction with Blackstone, I would probably say, and I'll speak for myself, for my office, when we filed the $1.6 billion lender liability claim, is probably representative of the wrongs that lenders also commit when committing to borrowers in providing capital to them. Because in my negotiations with billion-dollar funds, they act in a way that if they've done something wrong, one quintessential example is they tie the funding of a construction loan to an acrimonious list of preconditions and checklists that drop the due date for a temporary C of O even further and further and further, which, until we get new law, the 421 expires June 2026, that's a problem for a developer. And that causes damages for a developer. So I've seen lender liability claims, and I will see more of those claims moving forward for three reasons. The first reason is the lenders have trouble with determining the value of the asset.
Right.
2, determining the value of their asset. What is their asset? Their asset is the actual loan. Remember, when you're a bank, your deposits are your liabilities. Your loans are your assets. So it's the value of the loan, it's the value of the asset, which is the piece of real estate, and it's the value of the guarantor. Those are the three things that if you're in negotiations and you have your lawyer and you're listening to this right now, you should talk to your lawyer and say, look, I heard this crazy guy, Leo Jacobs, say there's three values here. There's the value of the loan, there's the value of the asset, there's the value of my guarantee. Am I being represented as the guarantor? Likely the answer is no, and you should get a lawyer for that because the interests of the guarantor are separate from the interest of the debtor. It's in the debtor's interest to sell its liabilities for less or a dollar. Why? Because the guarantor could carry that fall. So it's the guarantor, although it may be the same person, maybe not the same person, the guarantor needs competent representation in determining the value of the asset, the value of the loan, and then the value of their guarantee. That's all I wanted to say.
Listen, I think that goes back to what Eric was saying about why are large owners giving the keys back, right? They're seeing the playing field differently and they're seeing it from logic, and it's much more of a military strategy, which is our time and value, right, on that asset is better served elsewhere. So they make the deal with the lender and they don't fight and they can walk away because they are a business and they're thinking about it from a business perspective. Then you said, Eric had stated that, but if you litigate with a lender, you'll never do business in the future. Well, that middle market human is trying to protect the value and their dollars of maybe their future, everything that they've ever earned. So they're looking at it from a much more personal and irrational perspective, and they have to defend themselves. So it's just a different game and a different playing board within which we're looking at it. Yep. Your point about the guarantors is when the middle market is the responsible guarantor, they're not just thinking about the debtor, they're thinking about their families, they're thinking about their future. So you might as well fight. It's your Alamo right now. So Eric's saying, well, what about your future? They can't think about tomorrow. They got to get this done. They got to get out from this, and they'll determine if they can do real estate in the future. My perception, even if you're going to litigate in the future, whatever it is, you have to live to the next day to decide whether you're worried about the future lending or not.